ETFs, unlike mutual funds and unlike a stock, they have what we call the primary market and the secondary market. The primary market is where the money goes in and out of the ETF. The secondary market is where you and I and normal investors buy and sell the shares of the ETF. I see ETFs as an investment vehicles. I didn't say they were diversified investment vehicles. My mantra was to bring institutional strategies to the masses, bringing tools to investors and also tools for traders. Performance, if I knew where the performance of any particular ETF would be going, I would have been a trader rather than an ETF product developer.
Bienvenue sur Les Investisseurs 4.0, le podcast qui explore les stratégies et les méthodes pour développer son patrimoine immobilier quand on a 40 ans, un job à plein temps et une vie de famille trépidante. Dans l'univers des investissements, on entend beaucoup parler des ETF, tellement même qu'ils semblent l'outil indispensable de l'investisseur moderne sur les marchés financiers. Alors sans connaissance excessive sur ce produit, j'ai voulu me renseigner plus en avant et comprendre comment il fonctionne. Je me suis rapproché d'un expert en la matière, en la personne de Henry Jim, analyste spécialisé des ETF chez Bloomberg Intelligence. Henry a connu les premiers ETF il y a plus de 20 ans et en a développé plus d'une centaine en Europe au travers de sa carrière dans les banques d'investissement. Henry a aimablement accepté de nous accompagner sur cette série Deep Dive autour des ETF, autour de 4 séries d'interviews que je vais te proposer. Les ETF pour les nuls, comprendre les ETF, c'est la session que tu vas écouter aujourd'hui. Comment lire un prospectus d'infos sur les ETF, quelle stratégie avancée mettre en place pour performer avec les ETF, et puis une dernière session qu'on verra live en réponse à tes questions sur tout ce qu'on aura vu au cours des 3 premières sessions. Au cours de la conversation du jour, donc sur ETF pour les nuls ou ETF 101, on verra notamment qu'est-ce qu'un ETF, d'où vient ce produit et vers quoi il évolue, qu'est-ce qu'il apporte de plus par rapport à un fonds traditionnel, quels sont les avantages, inconvénients et risques liés à l'utilisation des ETF, quelle stratégie peut-on mettre en place pour utiliser les ETF à bon escient. Bref, tu vas sortir de cette conversation avec une bonne compréhension, déjà une bonne base de ce que sont les ETF, et tu seras du coup en bonne position pour assimiler mieux les prochains thèmes qu'on verra avec Henry sur les prochaines sessions. N'hésite pas à nous faire des retours d'ailleurs suite à cette première session pour nous dire si ça te plaît, si ça t'intéresse et quelles sont les questions déjà en avance que tu te poses par rapport aux ETF. On va essayer vraiment d'être extensif et de répondre à toutes tes questions. Pendant la session d'ailleurs, tu peux l'écouter en audio et la voir sur la chaîne YouTube. Henry fait référence à quelques slides notamment qu'il avait préparés et que je te propose de regarder sur la vidéo YouTube ou de télécharger si tu vas sur la page de l'épisode investisseur avec un s40.com/201 comme le numéro de l'épisode du jour, et tu pourras du coup suivre peut-être plus facilement et télécharger le support de présentation. For all you non-French speakers out there, hello, welcome to this show. You are going to listen to conversations between me and Henry Jim, ETF analyst and product developer with Bloomberg Intelligence. Today's session is all about understanding ETFs, what it does, and how to use them in building your portfolio. 3 more sessions on ETFs are coming your way soon about how to read prospectus, what strategies to implement involving ETFs, and a live open Q&A session at the end. So make sure you subscribe to this podcast and to the newsletter so that you don't miss anything. On these good words, let's start our conversation with Henry now. Hello, Henry. Welcome to Investors 4.0.
Hello, good morning. Bonjour.
Bonjour, Henry. Thank you very much for being here. I'm very glad to discuss a topic I've been willing to drill down on and do a deep dive on for a long time because it is still quite a little fuzzy to me and not really sure how to do that about ETF. We're going to talk about ETFs, so I'm really glad that we're starting these sessions on the topic. Henry, could you maybe just remind the audience who you are and a little bit of your background as well?
Sure. Well, thanks for inviting me, Paco. I'm really glad to be here. ETFs are my passion, so happy to talk about them. And they're my passion, as you can tell, when I explained to you that I've been in ETFs for over 20 years. I was a trader of ETFs, and then I was a ETF product developer at a company called State Street with the brand Spiders, and then with BlackRock iShares. These are in the States, but I was launching ETFs. I launched over 100 for Canada, US, and Latin America, and Europe. So yeah, really happy to talk about them. Currently, I'm at Bloomberg Intelligence doing ETF research, mainly focused on Europe, but I still keep my eye on the USA.
I'm curious, by the way, you have an engineer background at the beginning, because you're saying you were trading, so it sounds financial, but at the same time you help building the product. It sounds more like engineering. So what's the background behind that?
Yeah, in the States, well, my understanding is that in Europe, a lot of people with an engineering background do enter into finance, especially in France, with a lot of structured products. But in the States, I graduated with a bachelor's of commerce, so just business. And there are many different routes to enter into trading and finance in the States. So no, I don't have an engineering background. Just a keen interest on ETFs and the markets.
Great. And you started, when did you start, you said?
1999, 2000. I was trading ETFs versus index futures in Chicago. Yep.
Okay. And how just to get an overview as well of ETFs and how they started, 2000, were they midway through from the origin of ETF to now? When did ETF start, and how the market evolved?
The first ETF in the world was in Canada. They were tracking a Toronto Stock Exchange index. And the first one in the United States was the SPYDER, SPY ticker, and that tracked the S&P 500 index. And there was nothing much going on until 1996 with the launch of the World Equity Benchmarks by Morgan Stanley. And these were international equity ETFs. These were eventually bought out by Barclays Global International in 2000 and rebranded iShares. So that was, I would say 2000 is the real beginning of ETFs, because Barclays Global International then really pushed the iShares brand. They eventually got bought out by BlackRock, so now they're BlackRock iShares. But they were the main pushers of ETFs, and right now they command almost half the market in Europe.
Should have started by asking you first, by the way, what are ETFs for people who wonder what we're talking about?
No, that's true. Yes.
Yeah.
An ETF is an acronym. ETF is an acronym. It stands for Exchange Traded Funds. And like its name, an ETF is a mutual fund whose shares trade on an exchange. So, for example, a regular mutual fund, you buy from the mutual fund company or a mutual fund broker, and you deal directly with the mutual fund. The mutual fund has a record of you as an investor in their shares. An exchange-traded fund, you buy and sell the shares of the fund on an exchange like a stock from other people on the stock market. So you don't have a direct relationship with the fund company. They don't know who you are directly, right? So it's a mutual fund, but instead of buying it directly from the fund company, you buy and sell shares of the fund on an exchange. That's the basic definition of what an exchange-traded fund is.
And what room are they taking on the market? Why are they there? What are they for?
Yes. Well, they are there to provide access to investors to institutional strategies. That's how I used to view them when I was a product developer. And I say that because if you have a particular type of investment or strategy you want to invest in, if you were looking for a mutual fund, you have to find first the right company that you have established a relationship with them, and then you buy the fund. With an exchange-traded fund, you go onto your brokerage platform, like Boursorama or eToro. I'm not endorsing anyone, but just as an example, or Interactive Brokers. And you can then look through the list of listed ETFs and purchase what you want. So you have a lot more access to different strategies, right? Another reason they are getting popular and in the form that they are is that because you are buying and selling from other investors on the market and not dealing directly with the fund company saves a lot on costs, having to do the paperwork and tracking you and buying and selling every time there's a trade into their fund, thus reducing the costs tremendously. I think historically, a mutual fund could have charged minimum 1% plus all the fees. You'd go up to 5%, transaction fees and all, and commissions. With the ETF, you pay for the purchase, the transaction of the ETF shares. Depends on the broker, but you pay it once upfront and maybe when you sell. But also the annual fees, instead of 1% to 2% on average, they are now averaging around 20 bips. That's 20% of 1%. So, so their role is not just bringing institutional strategies to the masses, but it's also providing cost-efficient access to the general investment community. And that's why they've been just doubling in assets every 5 years. Right now in the world, there's about $10 trillion in ETFs. In Europe, there's almost 2 trillion now. So yeah, I think they play a really, I would say, important part in the investment community now. And we can also talk about how they are a very important trading vehicle later on.
Just to get some proportion about the numbers you just quoted, do you have any sense in terms of percentage of, I don't know what would be appropriate, but of probably investment that ETFs take, the place that they take in the market? Because those sound like very huge number, but just to get some perspective, is it still something like 5-10%, or is it more than that?
No, I think it's still around 5-10% last time I checked. If we assume like the total assets under assets under management by fund companies, like 50 to 100 trillion, I'm not sure. So 10 trillion is about 10%, something like that. Yeah, it's still fairly small.
And would you say like 10, 20 years ago that proportion was down much significantly, or it's been a slow growth?
No, it's been a rapid growth in the past 5 to 10 years. Yeah, I don't have the numbers off the top of my head.
Yeah.
But like I said, they've been doubling every 5 years in assets. It was slow at first because originally they were launched as index tracking products. And a lot of investors didn't see the appeal of only having the market average or the market average. But as we can talk later, I mean, there's many uses of index tracking, and there's also many different strategies coming on now. So they've been growing a lot faster as a function of their cost efficiency and accessibility. But also because of the proliferation of different strategies now, there's a lot of different uses for ETFs.
So you mentioned access and cost, obviously two main advantages, and reasons to use ETFs. Are there any other pros that that would make people go for ETF, or that would look attractive to them, to investors?
Sure. There's two more main ones. One is transparency, because historically, they tracked an index, and in order to get these launched and approved by the regulators, they had to disclose all their holdings on a daily basis. And mutual funds historically did not have to disclose all their holdings. They could wait. They would only have to disclose them 4 times a year after each quarter end, and they had about 3 months to 6 months to disclose them. So when you bought into a mutual fund at any particular point in time, you might not know what you actually bought till more than almost a year later, depending on the mutual fund. But ETFs, they have to disclose every day what they're holding. So when you buy, you know exactly what you bought into the day before. So transparency is one, and
if I may, sorry, Henry, if I may because that's very interesting. Because if I may challenge you on that, just not for knowledge, obviously, I don't know much more, but I just heard, or I was just watching a video where the point was reversed entirely, saying mutual funds run by professionals, they can adequately mark to market their position and reflect a change in the price much more quickly than an ETF. I don't know for what reason that was a comment there, but you're saying the actual opposite. Is it back? I mean, can you just give us a view? Yeah, just to understand on that point. Sorry.
Yeah, I'm not sure what you're referring to. However, mark to market or pricing at the end of the day is still not the same as disclosing the holdings. For example, let's say you have an active manager and they can price it correctly, whatever the market movement is, but they don't tell you what they did until 6 months later. Whereas with an ETF, even if they take 2 or 3 days longer to price something that's difficult to price, which does not happen. I worked there. They try to price it in right away. And then if there's some issues, they have a process on pricing things in a transparent way. You find out right away the next day. Yeah. So for example, if you buy a CAC 40 ETF, that's pretty straightforward. You're getting the 40 members of the index, right? But but even if you buy a traditional mutual fund and the index changes, you wouldn't know which members of the index you bought into months later. With an ETF, you see it every day, and it gets even more difficult to see what you're bought if it's an active mutual fund. Let's just say we are benchmarked to the CAC 40, but our performance has been this, and this is what happened in the past 6 months. But then you cannot make your investment decision anymore. Your performance is based on the decision you made 6 months ago, going in not knowing what you're buying.
So yeah, mutual fund managers don't have any obligation to reflect any change in the composition of the CAC 40, right?
In the CAC 40,
I mean, in the CAC 40, you might know anyway, otherwise, but in the ETF that you bought into, that's your point.
Yeah, they have to show it every day. Yeah. So that's the transparency is the first one. The second, the fourth benefit, since we mentioned 3 already, the fourth one is intraday accessibility. So if you buy a mutual fund, you say, I will buy 1,000 euros worth of this mutual fund. They take your order and the orders of everybody who's buying that day. And at the end of the day, they buy what they want to buy at the end of day prices or maybe intraday. But you won't know what you're getting, and you're only getting the price per share that they calculate at the end of the day. So what that means is if there's a lot of market movement, then you miss out on it. Let's say there's good news that's coming out, the stock market is rising, so you said, okay, I'll put in an order, but by the end of the day, the market's already run. It's already gone up, right? For example, hypothetical, a very specific situation. And there's many other different specific situations. What's the point is, you just don't know when you buy where you're going to end up. With an ETF, you buy as a stock on the exchange. So if the market is going up and you want to buy in, then you buy right now. And you get that price that's on the screen. That if we get to it, we'll explain how that price is a good intraday mirror of the index during the day. And likewise, if the market is going down and you hold the ETF, you want to get rid of it right away. Let's say, hypothetically, and you can do that right away on the screen on your platform. Whereas with a mutual fund, the market is tanking. You want to get out. You put a sell order. They wait until the end of the day to do all their sales, and you get what could be the lowest price of the day. Or you just don't know where it's going to end up, right? With an ETF, you have a bit more control at which point you want to enter or exit a position.
I would love to understand, deep down how that works and how that is made possible and drill more into the details. But maybe we can address that just a little bit later. But from what you're saying, at least two of the pros that you mentioned, and thinking of the transparency and the real access, real-time access, and as well as the ability to be very cost efficient. I see those two like make a powerful combination when it comes to using an ETF, because for trading purposes, like to put some strategy in place. Because if you have access, real time to your position, but every time you buy or sell, it costs you a fortune, you're not really incentive to do it. But in this case, you could very easily go in and out without too much friction cost wise, right?
Yes, and of course, it really depends on the platform you're using. Some brokers might charge more, some might charge less. So yes, I think from an investment vehicle perspective, the cost efficiency and the transparency are really big appeals. The intraday access, I think, enhances the appeal of the ETF as a trading vehicle.
Yeah. Do you think that that's also a reason why traders have flooded into the market a bit more, or even like normal investors, but using that as a way to be more active into their position?
You know what? I haven't given that much thought, but I would not say that it's because of ETFs that there's a higher number of people participating in the market. But I can definitely say that if it weren't for ETFs, we probably wouldn't see as many people, right? Because if there weren't ETFs, people would still be entering because this, technology is advancing, costs are coming down, markets are consolidating, but they would just be not limited, but they would the instruments that they would have at their disposal would be a lot less. Be single stocks, some derivatives, maybe. But with ETFs, we're providing many more instruments for people to trade, right?
Absolutely. There's one pro that I haven't heard you quote and mention, and I'm wondering if it's because you're not convinced yet, but it's about the performance actually of ETFs versus active trading. There are some studies, a SPIVA report coming out every year, basically saying, going on, long-term horizon, ETFs are winning over active, investing every time. But I mean, what's your view on performance of what that ETFs can bring generally compared to active management?
Okay. Well, I wouldn't say every time, because that would be like investment advice, and there's no guarantee. I wouldn't say every time. But yeah, the SPIVA you're mentioning, I believe that's the S&P study on active versus passive investments or something like that.
Yeah.
Right? The only reason I hesitate about the performance, two things. Not only reason. I have two reasons. One, as an ETF product developer in my past, I was really agnostic to what the potential upside would be, because in my experience, there are many financial cycles. You just don't know, things come and go. My mantra was to bring institutional strategies to the masses, bringing tools to investors and also tools for traders. So performance, if I knew where the performance of any particular ETF would be going, I would have been a trader rather than an ETF product developer in terms of performance. And in terms of comparison to active mutual funds, the fact is there's been a big increase in actively managed ETFs on the market in the US now too. So I wouldn't say that ETFs outperform mutual funds, but and instead, if you look at active versus passive, I would say that very broadly, I think passive gives you the appropriate return for the risk you're taking, right? Well, that's general investment investment basics, right? So no, I wouldn't say I wouldn't say ETFs are going to outperform actives. I wouldn't say outperformance is a major driver in the uptake of ETFs. Yep.
Right. No, I'm also saying that because I'm also not definite on that either. I'm not decided yet, and I guess my view on that also is that as the market's more sophisticated, as there are more products using ETF, mechanically there will be more ETFs that don't perform well, right? And therefore, I'm wondering if that statistical advantage, if you will, if you believe the Spiva report, will continue to hold true, given that more ETFs are going to be less well performing, and then over time they might actually align with performance, recorded historically on mutual funds.
Sure, I think I mean, I think I could agree with performance convergence between ETFs and actively managed ETFs and passive ETFs to a certain extent because of the rise of actively managed strategies coming online. There might be more that outperform. But yeah, it's really difficult to just focus on the performance to take performance of ETFs as a category as a whole.
Yeah,
because
sure.
As many strategies as there are, there's going to be as many ETFs. So it's really hard to say.
Mm-hmm.
Yeah, you can't just say I'll buy. You can say I would like to gain exposure to the CAC 40 or the S&P 500, which gives you a total market, right? You get the market performance, but there's no real way of saying I'll buy the ETF market.
No, of course, no, it doesn't make sense. I guess would you say though that before, and probably 20 to 30 years ago, ETFs were based mostly on very diversified indices, MSCI World, S&P 500, which brings the diversification, and that nowadays you can basically base your ETF on any underlying assets. You say, commodities, gold. Now you have ETH or Bitcoin. So that itself makes it, or you didn't have as many products before, and the products you had access through ETF before were very diversified, whereas now you have the ability through ETF to really go into a very concentrated make concentrated bet. Would you agree with that? Or?
Yeah, absolutely. I think it's still consistent with what I said before. I see ETFs as an investment vehicles. I didn't say they were diversified investment vehicles. So in the past, a very logical and rational approach would be to base ETFs off of indices, transparent, cost efficient, etc. But as they evolved into more concentrated asset classes or strategies, you can still use these different ETFs as building blocks for your own portfolio as investment vehicles. So yes, the one could say that the overall diversification has fallen, but with the proliferation of ETFs, your choices have increased. So you have more choice of instruments now.
Dans un court instant, on verra comment fonctionne la création et rédemption d'un ETF, les mécanismes qui assurent le maintien du prix d'un ETF aligné avec son sous-jacent et à quel risque de liquidité se confrontent les investisseurs. À tout de suite. Yeah, absolutely. No, it's good that you mentioned that, because I think maybe it's not really clear to people that ETFs are a vehicle and not a product by itself. So that, because I think in a lot of people's mind when I talk to them, it seems like ETF equals diversified portfolio, passive. You just put money, you don't think over what is behind it. But I think one needs to be maybe more, curious about what's behind that.
No, absolutely. Yeah. We can talk about, dig into more detail on how they're built if you want next. But right before that, to follow what you said right now, absolutely. The original ETFs, the big bulk of them, where most of the money is still, are in broad diversified equity and fixed income indices.
Mm-hmm.
Sure. But ETFs does not equal passive. Like you said, ETFs are just a vehicle, right? So you really got to keep that in mind. There are 13,000 ETFs in the world now. There's 2,100 in Europe, a little over 3,000 in the US. The rest are scattered around the world, right? Actually, it could be more, 35,000. Yeah, that's about right. So it's not possible to just say, I'll just put my money in an ETF. You, as an investor, you really have to do your research. You have to go through the normal investment process, thinking process. What are my goals? What kind of risk am I comfortable with? And then you start looking within those parameters at asset classes and strategies, et cetera, expected returns.
Are there any cons? We talked about the pros, but the cons of this this particular vehicle that you can see?
Right. So I think the main one, even now, is the friction costs of transacting in ETFs, especially here in Europe. So if you, depending on the market you're in, every time you buy an ETF, you might be charged for the purchase, plus there might be a percentage on the amount or based on the number of shares. And then they also charge you when you exit your position. And in some cases, they also charge you for holding the ETF, a custodial charge. So there are some custodial fees there. I think if you don't trade too often, well, I can't say for sure, but they might still in general be less than the commissions you pay on buying a mutual fund. This is not so much the case in the US, where it's become much more popular to invest in ETFs, much more competitive. Some brokerages are offering $0 trades, so free trading in ETFs, right? And they make their money elsewhere in sec lending or in the flows, right? So that would be the main thing: transaction costs, especially here in Europe.
Because just to follow on that point. I mean, on that thought, I imagine for a bank or a financial outlet, a platform, if you don't make money of the product itself, because the product, you say, is quite cheap, you have to make it, somewhere. So that's the reason why there is a cost to access those still through the platform, right?
Well, for a bank in Europe, yes, maybe. I said they're cheap. I didn't say they're not profitable. See, because the fund manager does not have to take on all the expenses as a mutual fund manager does, they still make a really good margin on ETFs. It becomes a question of scale now. It's not just how many clients you have, but it's how many assets you get. Because, for example, if an ETF issuer has one ETF and it costs them 200 to 500,000 euros to maintain it every year, they would have to have millions or €1 billion in it to maintain it because of the lower fees. But if they should add another ETF, that's also, let's say, similar strategies. They don't have to hire another person. They don't have to buy more systems. It's very scalable, right? And they double the revenues right there. So it's still very profitable, especially for those issuers that have many ETFs and many assets. But in terms of where how do other people make their money? Yes, if you're a mutual fund, it's your broker who sells, your advisor or the person who sells the mutual fund to you. In ETFs, it's more about the access points, like the brokerages and also the market makers who trade and make a market in the ETF shares.
Are there any other disadvantages we should think about?
So besides transaction costs, something I think might be a con is the sheer proliferation of products now. It's becoming not a challenge, but there's much more work in sifting through what type of strategies you want to invest in. The default is, if you don't know, go for the broad, diversified ones. But what I found is perhaps some investors find those not as sexy, so they start looking elsewhere, and you might get caught up in the excitement and either choose ones that might not be appropriate for your profile or transact a lot more than is called for. Yeah. So just the sheer number of products.
Yeah. And I think we were thinking about doing another session on how to read a prospectus, and I guess that's where it's going to come into play to understand what the important elements out of the information that is available. Because I agree with you in that transparency is great, but when you flood it with too many information, it could actually be, as an investor, a con for you because you don't have the time to read through everything.
That's why it's always recommended. Well, no, I would recommend starting with a goal first, and then it gets a little easier. You know what you're looking for, and what are your limits.
We were just mentioning a little bit offline. We were thinking about talking about how to buy them, and we were just sifting through Google pages, because in France, obviously, how you can buy ETF in France is different from how you can buy them in the US or in Asia, I guess. Even though, I mean, conceptually, I would think if access is a strong point, we should be able wherever we are to access ETFs and buy them, right? But I guess that's not really the case, though.
I think the accessibility of ETFs is a function of the accessibility to the stock market in France, because they trade like a stock. So if it's easy to access the market for stocks, then it should be easy to access for ETFs. My understanding is it's not always that easy in France. That's the issue. I've had friends in France who, we talk about ETFs and they think it's a great idea, but when it comes down to how do you actually buy an ETF in France, it's difficult to open an account, but maybe not so much anymore, or it's really expensive, right? Yeah. So I guess the additional challenge for a French investor is to identify how to actually access the product. It's still relatively cheaper and maybe even easier than buying a mutual fund. Maybe not that, right? But yes, there is a little more work as a French investor to access ETFs.
Yeah, one point I forgot to mention, but maybe in the cons section, is there any reporting requirements or any regulatory hurdle, linked to you as an investor holding ETFs as opposed to holding a share in directly from of a company?
What I do know is just broadly speaking, I think it's European investors, they are limited in the US ETFs that they can invest in, because those are now limited to sophisticated or professional investors. So if you're a European-based investor, you only have access to European listed ETFs.
Okay.
Yeah. Unless if you somehow declare yourself as professional or advanced, right? Yeah. But that also then opens you up to a lot of other investment risks.
It really sounds like, as you mentioned earlier, that ETFs are really, really linked to the stock market. I mean, they're based on stock market. You were talking about intraday trades, but it's still during opening hours. We're not talking about, crypto, for example, where crypto exchanges, you can, it's 24/7, 7 days a week. So we're still with a product that is, intrinsically very based with public stock exchange. And I guess that could be a segue for us to understand how they're built and how they, all the features you mentioned, accessibility, intraday trading, transparency, how the, how it's made possible. Maybe that could be a good.
Okay. Well, maybe I'll take you through an example, a general view of the features of an ETF, and take it from there, okay?
Yeah, great.
Maybe I'll share my screen here.
Sure.
So, as I mentioned, I'm with Bloomberg Intelligence covering ETFs, and this is a little presentation I give to general public, colleagues, people who are interested. Just an overview of how ETFs work. Before I go into it, I just wanted to preface by saying ETFs are like stocks; they trade on exchange. And they are also mutual funds. So they actually have both features. So they trade like a stock, but there is at some point they have to at some point collect money to have their portfolio, right? So ETFs, unlike mutual funds and unlike a stock, they have what we call the primary market and the secondary market. The primary market is where the money goes in and out of the ETF. The secondary market is where you and I and normal investors buy and sell the shares of the ETF. Okay, so let's keep that in mind for now. There's a primary market and a secondary market. So I call this the ETF ecosystem, just broadly speaking. And we start with the ETF issuer, the authorized participant, the exchanges, and the investors. So these are the participants in the market, right?
Yeah.
I would group this into four. So you have the ETF, the authorized participant, which I'll go into what it is later, where they're bought and sold, and who buys them. Let's take an example. In this case, the S&P 500, which is an index of the U.S. stock market, of the 500 largest and most important companies on the U.S. stock market, representing, I think, roughly 90% of the market cap of the U.S. exchange. But it could be the CAC 42. We use the S&P 500 right now. And then we take a look at the ETF that tracks the S&P 500 here in Europe, the CSPX, listed in London, but it could be cross-listed in other markets as well, on Euronext or on Frankfurt, etc. And let's say today at T0, right, we have the index at a level of 100, right? And let's say the ETF is trading at 100 euros right now, just to start at a common point. At this particular time, good news comes out. Unemployment numbers are down or production is up, whatever good news is. One could say for the US, and we could say, okay, in general, this is good news for the US market. And in general, I think the US economy is going to see an uptick, right? So what do I do, right? Well, then it's investors, institutions or individuals or hedge funds, whatever, they will then want to buy the S&P 500.
Yeah,
to get access to get exposure to this potential uplift. However, let's say unemployment goes down, as a specific example, that's not always good news for every company on the S&P 500. Let's say there's companies involved in relocating people or paying out unemployment benefits. Well, they're not going to do as well if there's going to be less unemployment. So at that particular moment, there's going to be a lot of buying and selling in the names of the S&P 500. Some will go down, some will go up. However, overall, if the numbers are good, that means it's good for the economy. And that, first of all, there's going to be a lot of buying and selling. So at that moment, the index will still be at 100 because there's so much noise going on. But overall, the market is going to go up and people are going to say, I want to buy the whole market. How do I do that? We'll buy the ETF. That's the fastest way to get into the market. And if they all go in and buy more than selling of the CSPX, buy the CSPX off of the market, we might see the price of the CSPX go up, let's say by €1.
So CSPX is the ETF that's tracking the S&P 500, right?
Right. So the S&P 500 is an index. You can't buy it. Or if you buy, you have to buy all 500 names, which is really expensive and you need a lot of money. But with an ETF, you can just buy a portion of that, right? It's a share. So they're buying the CSPX. That's something you can buy. Push up the price to 101, just a little bit, right? And so there's going to be a lot of buying of CSPX off the market. And now, authorized participant. An authorized participant is an entity who is the only entity allowed or has entered into a contract with the ETF issuer to buy and sell ETF shares. So you and I cannot buy directly, as we mentioned at the beginning of this talk, directly from the ETF, but these guys can. But they can only buy in blocks.
Okay.
Of 100,000 euros to 1 million to 10 million euros block. So they're in a very good position because if a lot of people are buying the CSPX off the market, pushing the price up to 100, right? Then the authorized participants will say, hey, you know what? I'll sell the CSPX to you for 101, right?
Yeah.
And I'll buy the 500 names of the S&P for a value of 100. So they have to buy in proportion, right? And then they make a profit by arbitrage, right?
Yeah. Would you say the authorized participants are the equivalent for active management of mutual fund managers?
There are no equivalent of an authorized participant for active mutual funds. What happens is if people want to buy the S&P 500, they go to an active manager that has it, and then they say, give me your money. And then at the end of the day, they'll buy the S&P 500 themselves.
Right.
There's no authorized participant.
Okay. So in this case, the authorized participants are just basically traders who are making money off arbitrage, right?
Yes. And so they will then, now they have, now they're holding the S&P 500 securities, and they are short the CSPX. They owe the CSPX to people they sold to. So they're going to turn around now and go to the ETF issuer and say, hey, I need CSPX shares. I'll buy them from you, and I will give you instead the S&P 500 names or cash or whatever. They did the equivalent, right?
Mm-hmm.
That way, they got rid of their S&P 500 stocks, and they also have now covered their short of the CSPX, and they make a profit, right? With no position. Now they have a cash profit. Same thing in reverse. There's bad news. Economy is going to be going down, but it depends on what the news is. There's going to be a lot of buying and selling of the S&P 500 names. The index at that nanosecond is going to be still at 100 in real time, but overall, it's the bad news indicates bad for the economy. People are going to sell, and the fastest way to sell the whole market is CSPX, pushing the price down to say 99. That brings in the authorized participant again. He's going to buy the CSPX for 99, sell the S&P 500 names for 100, making a paper profit at this point of €1. And then he's going to just turn around, it's arbitrage, turn around and say to the ETF issuer, here, I have all these CSPX shares. I don't need them anymore. I want my profit. I'll give them to you. In exchange, you give me the S&P 500 out of your ETF, and that clears up position, and they keep the profit of €1, right?
That mechanism, I mean, relies a lot on the ability, on the liquidity on the market, right? On the ability for the ETF issuer to be actually transactioning with the authorized participant at any given time, right? How does that work?
So if you think about it, they have to do it in large blocks, and to reach that threshold of a large block, you don't reach it all the time. And in fact, a lot of times you don't reach it, and a lot of the transaction just happens between the exchange and the investors. So the liquidity is of the ETF shares. Now, if you're talking about lack of liquidity in a particular name, these are very large indices. But even the smaller ones, what the authorized participant will do is they'll make the spread a little wider, and they make their profit there.
Mm-hmm.
Another thing is when you're talking about liquidity, all these things, all these prices are baked in. So, like, the authorized participant would not partake in this transaction if there wasn't enough shares to accumulate to make that profit.
Yeah, sure. No, that's clear. That's clear.
I just finish terminology.
Sure.
This is called the creation, when shares are created of the ETF to provide to the AP, and this is redemption. And the reason this works is, well, let's take a look at what's happening then on the S&P 500. Because of this arbitrage mechanism, the investor who is buying or selling the CSPX knows that if the price of the ETF goes out of line with the index, someone is there to bring it back in line. So they're not going to be paying more than they should at that time for that basket of securities, or get less than they should.
Yeah.
In theory, anyway. And that's because of the arbitrage mechanism. It keeps the price of the ETF close in line with what the index is indicating the value is.
And so it guarantees the parity, and so it gives a comfort to investors that it's safe, or at least that they won't suffer any fluctuations by going into an ECS as opposed to going into buying the index, right?
Yes, and to buy all 500 names will take you a long time and a lot of money because you'd be paying per each name as well, right?
But are there any chances, any risk that the AP participant comes and wants to sell the to the ETF issuer or buy and doesn't get any counterparty, or the ETF issuer is unable to give to exchange in exchange? See what I mean? Like if there is so many people wanting to or so many APs wanting to sell the ETF at one particular point, is there any chance that the ETF issuer is not able to buy back an exchange and make the transactions between the AP and the ETF issuer?
No, the only limit is at least in some markets is they have to hold at least one block of ETF shares. But there's no limit because that is the only limit. Because if you think about it, the let's say the ETF has 100 million in assets, and it's holding the stocks, right? So the AP says, okay, I want to take out 90 million, and the ETF issuer just looks at what they have, they give them the 90 million, and they cancel the 90 million shares.
Oh, so that's what the redemption is then. If that happens, they cancel the shares, the ETF, yep. Right?
They take the shares back from the AP, and they cancel them, and they give them the cash or the underlying stocks.
All right.
Right. And also something you'll see is that if you look on your platforms where you buy and sell stock, you might see that there's not much volume in the ETF shares. But that's a frequent criticism we hear in the market. Oh, there's no one's trading this ETF. Well, the fact is, if you the APs and many stock markets, they have designated market makers. They are supposed to make a market. Sometimes they're tight, sometimes not so tight. But in theory, there should be someone making a market for you. So you could go in and still buy the ETF. And if you want a really big size trade, then in theory, the author participant should be able to fulfill your trade because they have a release mechanism on the creation and redemption side on the primary market, right? So the interaction between the ETF issuer and the author participant is called the primary market, and everything else is the secondary market. So even if you don't see much liquidity or much trading going on the secondary market, the liquidity of the ETF share is the function of the liquidity of the underlying securities. So if you're looking at whether there's volume, you should look at how liquid the underlying S&P 500 is.
Yeah.
Just to finish it though, a lot of indices, if it's index-based, they actually have liquidity filters baked into the index methodology. So there's minimum requirements for liquidity too. So
yeah. No, that's a very good point, because we were mentioning here the S&P 500, which obviously is very broad, very robust in terms of liquidity. I don't think anybody is expecting that the liquidity runs out of that underlying asset. But as you know, the ETFs I always mentioned is dive into more exotic assets, gold or now Bitcoin, for example. How does the ETF issuer? I mean, what's the mechanics between the underlying assets really and the ETF issuer? You mentioned here for the S&P 500, it buys all of the shares, so it has it in its book, and basically that gives the liquidity, the comfort. Is it the same for any underlying asset? So if it's based on gold, the ETF issuer buys the adequate gold, and it's like on par. And you see where I'm going to that as well. Is like when we mentioned synthetic ETFs, we might get to a situation where the ETF issuer is issuing an ETF based on an asset that it doesn't hold.
Well, I think we might leave synthetics for another session.
Yeah. Okay.
But to answer your question about the liquidity, the underlying, first let's look specific at gold. The way gold ETFs works, or other precious metals, some precious metals like silver maybe, is it's the same arbitrage. It's but instead of the authorized participants just buying gold, what they'll do is they'll put in an order to the ETF issuer and say, hey, gold is trading at 2001. It's trading at 2000. The ETF is trading at 2001. So I'll give you the 2000. The ETF issuer takes the money and then issue shares. But in the back, what they'll do is they actually go to a vault holding gold bars and say, okay, allocate these bars to my ETF. So each share has a claim on a bar of gold in this vault, right? So there is still, assets backing the shares. Synthetics is a whole different story that we should probably address. Recall, yeah.
No, very, very good call. I think it's better we address it a little bit later. But no, I think I get your point, and if I, in my mind, and correct me if I'm wrong, basically ETF issuers are like super investors. They hold assets and they issue and redeem shares adequately, to the extent that almost real time, or probably real time, one share equals one underlying asset. There's no discrepancies between them because they are able to create shares as they buy more or they hold more assets, and redeem them as on the other way around, right? So I guess they're just like, they give you access to the assets that they hold on their books and issue shares in exchange. Is that a correct definition or correct way to see it?
It's like right. Oh. And that's why another metric that we look at in ETFs when assessing, how good they are, performance is something that's important to some people. As an ETF product developer, one of my metrics is how far the NAV, the net asset value of each share of an ETF, deviated from its index. So the performance of the ETF share, NAV performance, how far does it deviate from the performance of the index? Right? And in theory, it should be really close. In a perfect world, it would just be perfect minus the fees, right? The small fees.
Okay. Yeah.
Yes. The performance should be tracking the index very closely because they're holding the same constituents of the index in the same proportions.
Yeah.
Generally speaking.
That's a very good point. I think and that's key. I think as an investor to measure is how robust the thing is. So yeah.
Yeah, but there's always no guarantees in life, but it had this mechanism, this arbitrage, creation, redemption, and arbitrage mechanism has proven pretty robust. Yep.
Yeah, I guess that's the track record speaks for itself and makes it, as time goes by, a more sound, or I guess if you compare again to, I'm pretty much into DeFi these days and in crypto, and the system is so new. There's so many hacks, so many ways and loops. And if you just compare just system wise, I guess ETFs are on the market for so long that you can really, and as you said, it's pretty one-to-one. We can see the mechanism. It's just transparent as well. So I guess that gives confidence as well that it's safe for, and I guess that's why pension funds in the US go into them, because it's
Yep. Again, it's I do have to be careful. I can't say anything is safe, right? But it's definitely proven really robust. It seems to be working still, and I think the mechanism speaks for itself in terms of robustness. Investors are also voting in the same way by investing in ETFs as they discover the merits of ETFs, cost efficiency, transparency, and liquidity. It seems to be working, and I think the biggest challenge for the industry now is education, right? As we're having this talk, for example, the concept is fairly straightforward. It's an access investment vehicle and also a trading vehicle. But as you can see from this chart, it can get the details can get pretty technical and complicated. but it's because of the structure that the things work, right? And I think when you're talking to investors about investment merits, that's a conversation that is relatable. But when you get into the details of how it works, this is where a lot of people step back and have to take a pause and think through it, you know?
And would you say it's a plus or it's a benefit for investors when it comes to ETF to really understand what's behind them? Or in other words, you think investors are better off knowing more details than they probably have appetite for before investing in ETF?
Yeah, absolutely. They definitely should have a general understanding of what's going on behind. But it's like if you have a car, I mean, you generally know how an engine works, but you don't have to know all the details of of internal combustion to really drive a car, right? But also you have to know you have to change the oil and add gas to make it run.
Yeah.
So yeah, no, I mean, and for in general, the more you know, the better, right? Especially if it's your money. Right?
Yeah, absolutely. All right. Well, that's been great, I think, for a good overview. Is there anything we're missing out, or we're missing on the broad understanding of what is an ETF, which was the subject of this session?
Actually, I guess one last thing is use case scenarios. We talked broadly about investments and trading, but as the number of ETFs proliferate and there's so many of them, something you and I talked about this before this call is there's different ways of using them now, different use case scenarios. So whereas before, I still think maybe one of the simplest ways is to buy like an index S&P 500 or a CAC 40 ETF and just let it be, don't trade too much. But as there's a lot more strategies coming out now, investors have a lot more choices. So if the investor is so inclined, do your homework, and you can also now have different building blocks to build your own portfolio. Yeah. So there's many options. You go really simple, or you can get really complex.
Awesome. Well, thanks a lot, Henry, for your time on this. We have other sessions coming up, so I'm pretty excited to go into them later. But I think for anyone not knowing what an ETF is, I think coming out of this conversation was very enlightening. At least for me, it was. So thank you very much for your time. Appreciate it.
My pleasure. Thank you. And if you're on Twitter, I'm on ETF Hearsay.
I was going to ask. Yeah.
Track all the U.S. filings and listings and miscellaneous ETF developments.
Yep. So there's definitely an account on Twitter, on X, that we should follow. I'll put them on the note as well. And what I'll do is I'll put a link as well for people to be able to ask some questions, because as we mentioned, we are going to do some further sessions on this, and it might be useful to understand as well what's on people's minds. So I'll put a link which is going to be investisseurs with an s40.com/ETF. I'll put a questionnaire there, so you have the ability as you come out of this session to ask questions that we could address maybe for in our next sessions. So you can address a message, I guess, to Henry through his Twitter account, or use that link as well. That could be useful for us to understand what's on your mind and help you out understanding ETFs finally.
Sounds good.
Awesome. Thank you very much, Henry, again.
Thank you.
Take care. Bye.